Okay, we're picking back up on page 111, and what we're going to talk about in this session is depreciation expense, and try to get through with our adjusting entries and get to our adjusted trial balance and summarizing the adjusting process. Anytime we have fixed assets or planned assets, they're physical resources that are owned and used by the business and are permanent or have a long life. We have an account associated with that called depreciation. If you own a car, you know that your car is worth less this year than it was last year, and that's because of depreciation. So we all kind of have a little bit of a sense about depreciation. I'm sorry, let me get back to the correct slide. Depreciation is what happens as time passes. A fixed asset loses its ability to provide useful services, and that decrease is called depreciation. And like I said, if you own a car, you understand about depreciation. Our house would actually depreciate if we never did anything to it. We know the value of that house would drop over time just from lack of maintaining the property. But usually our houses don't really lose value. But if you had a building in a business, you still write it off because it does lose. Commercial property definitely loses value over a period of time. This is the title, the normal titles for our fixed assets account, and each one of those will have a contra account called accumulated depreciation, in which we record that depreciation expense against accumulated depreciation account. Of course, land does not, there's no depreciation on land, so there's no contra account for land. Buildings, we would have the buildings account, and then we would have a contra account called accumulated depreciation buildings. Store equipment, another fixed asset account, we'd have a contra account called accumulated depreciation store equipment. And then office equipment, we'd have another contra account called accumulated depreciation office equipment. Now, on December the 31st, Net Solution estimated that it had $50 worth of depreciation against its office equipment for the month of December. So our adjusting entry would look like this. We would debit the depreciation expense account and credit that contra account office equipment. So we always keep the office equipment on there at its original value, and I think in this case, I think it was $1,800. But this accumulated depreciation will keep increasing until it gets up to the $1,800, and then we have a zero book value. But like I said, we debit depreciation expense, credit accumulated depreciation office expense, and post that to our two ledgers, our depreciation expense ledger and our accumulated depreciation office equipment ledger. And this just shows how it would be shown on the balance sheet. On the balance sheet, we'd see office equipment $1,800 less accumulated depreciation $50, showing a book value of $1,750. Now we're going to take a look at a practice exercise or an example exercise, and this is example exercise 3-7, which is on page 113 in your book. And here we have estimated our depreciation to be $4,250 for the period. So we would debit the depreciation expense, and this is against our equipment account. Debit depreciation expense $4,250, credit accumulated depreciation equipment $4,250. So that's the adjusting entries that we would normally see in most businesses at the end of each period. Now I want you to take a look at your the adjusting entries, and these are shown on page 116, and the ledgers are shown on page 117 in your book. I want you to take a look at those entries and how they would be recorded in your ledgers. It's on the ledgers on page 117 and 118. and just see if you can follow those, how we make the entries and how they're recorded in your ledgers. Remember, the first one we adjusted was supplies expense, the next one was insurance expense, and then unearned rent, and then fees earned that had not been billed, so we debit the accounts receivable and credit the fees. Then we also adjusted for wages that had been we were responsible for that had not been recorded, so we accrued our wages, and then we showed our depreciation expense and net solutions. This is the journal entries, and this shows how they would be shown in your different ledger accounts. The next several slides shows how they'll look. But make sure you look at page 116, 117, and 118 in your book, and that you follow these through so you can see how your different accounts are affected. Okay, we're going to take a look at another example exercise, and this one is 3-8, and it's on page 113, and it says, for the year ended December the 31st, 2010, Mann Medical mistakenly omitted adjusting entries of $8,600 of unearned revenue that was earned, and earned revenue of $12,500 that was not billed. And then they failed to accrue their wages of $2,900, and they want to know the total effect of this on revenues, expenses, and net income. Well, we can see from the information here that they understated their revenues by $8,600 plus $12,500, so they understated their revenues by $21,100. And I'm going to pull up that slide so you can see that hopefully that I did my math correct, and I did. So they understated the revenues by $21,100, a total of the $8,600 and the $12,500, and they underreported their expenses by $2,900. And so the net effect on our net income was, if you take the understated revenue and subtract the understated expenses, you get $18,200. So we understated our net income, or this company understated its net income by $18,200. Once we've made, before we did our adjusting entries, we did an unadjusted trial balance. Once we do the adjusting entries, we prepare an adjusted trial balance. And the purpose of that adjusted trial balance is to verify that our debits equal our credits before the financial statements are prepared. So anytime we make entries, we always want to check the quality of our debits and credits. And this is what our adjusted trial balance would look like. And this is on page, I think, I think it's on page 119 in your book. So take a look at that adjusted trial balance in your book. And then we're going to look at another practice exercise, 3-9. And again, this deals with effects of errors on the adjusted trial balance. And it wants us to tell how each one of these errors individually, or how they affect things individually, and then tell whether or not we can have an error and still have our debits equal our credits, or we can have some errors in which our debits won't equal our credits. The first one, it says the adjustment for accrued fees of $5,340 was journalized as a debit to accounts payable for $5,340 and a credit to fees earned, $53,440. So we can see our debit equals our credit. The only problem we have with this one is we should have debited accounts receivable for $5,340, and we see that on this slide. It says down at the bottom, it says the totals are equal for the transaction we just discussed, even though the debit should have been to accounts receivable instead of accounts payable. And then our second entry, we recorded adjustment for depreciation of $3,260. We journalized it as a debit to the depreciation expense for $3,620. We made a transposition there, and we put the correct credit into accumulated depreciation, $3,260. So when we subtract, we see we have a $360 difference in our debits and the credits, and that 360 is equally divisible by 9, so we know to look for a transposition error, and hopefully we'll find that fairly quickly. And this concludes chapter 3. I hope you enjoyed it, and I hope you get a good understanding of this chapter and how it works in accounting. Thank you, and have a great day.